Welcome to Pearson Bryson's Stock Alphabet. My name's Conrad. I'm going to share what that means. When I mean stock alphabet, you know how you count A through Z, A, B, C, D, E, F, all the way through Z, just like the alphabet. There's 26 characters in the alphabet. We believe in selecting 26 different companies of stocks to invest in, which creates quite a diversified portfolio. So simply put, I'll flip this around, let you actually see my laptop actually. So I'm in my Charles Schwab account where we're going to be using a trade and buy, sell, etc. We're going to show behind the scenes on what it's like to invest here and how we invest. So essentially what I do is the letter A for today. As you see, I'll put the letter A and you'll see a few different companies that pop up. The one I'm going to select is Apple. AAPL is the stock ticker, but you can select any company you like and you can follow along if you like, but it's quite fun. And so I'll select Apple, and I do that with every single alphabet, all 26 letters of the alphabet. I'll go to B, put the letter B, whatever company falls under B, I'll select the company, I'll research a bit, I'll go through the EDGAR system, I left a link below, where we look at the 10Ks, and if they're doing well, if they follow our framework of investment thinking, where we select companies that, for example, I'm more inclined to invest in companies that are vertically integrated. Apple, for the most part, is a vertically integrated company. Where they are vertically disintegrated, though, is unfortunate part where they outsource a lot of the manufacturing component. But that's totally fine because what that does is it allows them to have a bit more freedom while also having control. They do control the machine that creates the machine, but the machine is created by a vertically disintegrated outsourcing. And all that means is just means it's being outsourced. So sorry if I'm using that wording, but that's the proper word to use. Vertically disintegrated just means outsourcing. Vertically integrated typically is a company that the machine that builds the machine and it owns all the steps in the process essentially. I typically am more inclined, that's my own method of thinking and that's my own personality. It doesn't make it right or wrong. You might have a different way of thinking, which is totally fine. But I'm going to select Apple for that reason. And I did a bit of research on it. And what I do essentially is through each letter I select from letter A, letter B, letter C, letter D, all the way to the letter Z, I'll select one company and I'll keep investing in that company. But I believe in building my conviction. So that way, if the stock goes up, if it goes down, if I truly believe in a company, I'll actually buy more the more that it declines because I look at that as a discount. Most people, at least that I've met, for the most part, when they see green, it's a natural human instinct, we get happy. You see your stock grow. When it goes red, you're not too happy. I look at it where I essentially actually invest in companies that go red. If I truly believe in them, I'll buy more. And if it works out, it's basically a discount. And all this is speculation until it's proven. So, but that's my method of thinking. Again, I'm not sure telling you to invest in that fashion, but that's the way I invest. I'm gonna share my method of thinking right here. So I chose Apple for the most part. First, it's traded on the NASDAQ Stock Exchange. For those that didn't know, stock ticker AAPL. It's been a phenomenal company. I love Apple. I do like Apple products. I actually prefer, and don't hate me for this, I prefer Samsung though when it comes to technology phones, but I do appreciate what Apple brings to the table and the world loves Apple. So even if I love Samsung or I love something, I will separate my own personal beliefs and I look at it strictly as an investment opportunity. And I personally love Android and Samsung, but Apple, definitely a worthy competitor. So I'm still going to invest, and that's just sharing with you that even if you don't believe in a company's trajectory, if the numbers add up and it doesn't align with yours, sometimes it's still okay to invest, but you have to go through that method of thinking yourself. But anyways, I digress. Let me get back to the product, the process. So I'll invest in Apple, and the reason why is because they're vertically integrated. What really is a strong indicator for me personally, and I invest a little bit differently. They've had 5 stock exchanges, stock splits, and the first one was June 6, 1987. It was a 2-for-1. So I'll give you a simple example. For example, say the stock was worth $100, right? And it did a stock split for 2-for-1. Each one will be worth 50-50, but you get more shares, but it's the same value, but it equates to the same amount. And you might ask, why is a stock split done? You guys might know the answer, or if you don't, not a problem. Simply put, won't take too much time on this. It just makes it more accessible for investors that maybe it's a bit priced high for. Apple's gotten to the point where it's definitely surged and went through the moon multiple times back and forth, and it's got pretty expensive, pretty high for most investors. So what Apple typically likes to do is bring it down. That way, it makes it more accessible. That means they keep getting early investors that are not accredited investors, that are people that are trading through a stock exchange or stock brokerage firm like you or I, through a Charles Schwab account, through a Robinhood account, through Chase, etc., through Sophie, etc., Fidelity. And if it gets priced too high, they decide to split it to make it more easier to afford. And that way it kind of keeps it more liquid as well. But another caveat to this is the Dow Jones. The reason you have to know about the Dow Jones, it's very different from the S&P 500. The S&P 500 essentially is based off value of a company. So for example, if a company's worth say 1.5 billion and another one's worth 1.5 million, the company that's worth 1.5 billion will have a lot more influence on the S&P market, essentially, S&P 500 market. It's a little different for the Dow Jones. The Dow Jones is not company, based off company value. It's based simply on, it's price weighted. And what that essentially means is that if you have a company that could be a startup company that's worth, say, 1 million, say example 1.5 million, and the other company's worth 1.5 billion, but the company that's worth 1.5 billion is worth $100 per share, but the company that's worth 1.5 million is worth $400 per share. What this causes is it causes what they call a distortion. So the distortion essentially is when a company that is valued, a price valued high, it influences the Dow Jones. That causes distortion, inaccuracies, and quite a bit of fallacies actually. And so what it does essentially to keep the the market balanced for the Dow Jones, companies like Apple and other companies that get priced fairly high, they'll split it not only to create more liquidity for investors, they bring the price down to make it more accessible, but most importantly, to balance out the Dow Jones. And because it can really distort the numbers, which is not always a good thing in the market, but I don't want to go for, that's a whole other video I'm going to go into. But long story short, Apple has had 5 stock splits, which is phenomenal. That means, and that indicates to me and signals to me, first, that Apple believes in long-term growth, which they've been right all 5 times. As of today's date, 2026, January 4th, they've actually split 5 times. And if they keep splitting, that means that they split, bring the price down, and they expect to bring it back up. So that's kind of like what's going on here. Is it gets to a point where it's been split so many times, they do believe in the long-term growth that's going to come back up, and it's done it every single time. June 21st, it was the same thing as the June 16th. It was split 2 for 1. So same example, say the stock was worth $100, it got split to 50, for example, but worth the same value. It's the same value, you just get more shares, which causes more liquidity. February 28th, 2005, it was 2 for 1, same thing. June 9th, it gets real interesting. 2014, 7 for 1. Crazy, 7 for 1. That is absolutely incredible. And when you think about it, that's almost like $13, $14 per share. If it was worth $100, it got split quite low, but it made it really liquefied for people to actually be able to invest. And then August 31st, 2020, is 4 for 1. So say it's $100, it gets split to about $25 a piece, but same value. So essentially, the reason why these are good indicators because it shows that the company believes that they're so valuable, they know they're going to come back up the chain, but they're going to split it so low to make it more accessible. That's a key signal for me. Second, what makes it a key signal is the fact that they did go through the whole stock split, is that first and foremost, they've done it 5 times, so their experience actually is an indicator to me. And I like the fact that just in general, they are more of a hybrid. I mean, they're by far a vertically integrated company, but they are a hybrid when it comes to the vertically disintegration. Vertically disintegrated, because what happens is that they do outsource basically like the machinery of it, like the supplies of it, but the technology, the websites, the stores, the app stores as well, they're all controlled and created and ran by Apple, which I really love and is really attractive, and it's been like that for a long time. And that's like a really strong indicator for me for the most part. The cool thing about this, Apple, is you don't have to buy Apple shares 1 for 1 if you want to. You can even fractionalize it. So we're going to buy whole stocks, but if you say have the capital, or if you just don't want to spend the full amount, You can actually purchase fractional shares through like Robinhood, Fidelity, Charles Schwab as well. And a lot of other, I think even Cash App, I think there's one for cash investments as well through Cash App. Correct me if I'm wrong though. But yeah, there's quite a bit of other ways you can purchase shares if you don't have the capital and maybe say $270 or $300 too much. You could break it up into increments and buy a percentage of a share, where it doesn't have to be a whole. It could be like 0.50 or it could be like 0.25, like 1/4, etc. Pretty cool way to at least just get in the market, get your feet wet, and just kind of get your feet and hands dirty, just like learning the ropes. I'm not perfect. This is fun for me. I can do this all day. I just want to share my method of thinking. And by no means this is telling you to invest in Apple. I'm just sharing what I'm going to be doing. I'm building a portfolio of 26 different companies. I've done this many times over. This is the first time I'm doing it on camera though. So you're just going to see. And once you get to this, the 26 company, letter Z, for example, what I do essentially is I'll just keep reinvesting in those 26 companies. And then if I want to build a whole nother portfolio of 26 companies, I just do it all over again. It's really fun. You get better with time. Again, I'm no perfection. I'm not perfect. So there might be errors, but that's kind of what's fun about this. The most brilliant investors have made mistakes, and you can't fully predict the market, but utilizing your resources, mentality, insights, experiences, history as well can really help mitigate the losses. So we're definitely going to invest in Apple, stock to AAPL, and it's going to be quite fun. And yeah, I'm looking forward to you guys investing as well. It doesn't have to even be Apple. It could be any company that's a letter A. And you can even go to letter B. You don't have to start at A, but we're starting A, and that's kind of what we do is go through the alphabet: A, B, C, D, E, F, G, H, I, J, K, L, M, N, O, P, Q, R, S, T, U, V, W, X, Y, Z. Feels like I'm in kindergarten again. But anyways, like, subscribe, share. Welcome to Pearson Bryson.